in these little narratives, aren't you? And all you're trying to do is understand the relationship. You're trying to look at these and say, I understand this relationship. I kind of understand how far, how wide it can go. I'm trying to make sure that by the time I get the buy price in place, that the spread is as wide as possible, and kind of limit yourself to maybe 10 spreads maximum. And all you're trying to do is capture the 10 spreads. You're trying to capture as wide a spread as you possibly can do in these narratives. You're trying to capture as wide a spread as you possibly can do in these narratives. And the difference between these two lines, of course, is the P&L. So the wider it goes, the more you like the trade, right? The wider it goes. But here's the other thing you start recognizing. The euro moves a lot more than the yen does. No shit, Sherlock. Well, of course it does. That's what we understand to be normal in the marketplace, is that euro moves a lot more than the yen. So for that reason, of course, we've got a volatility spread. So if we're going to try and trade this as a volatility spread, what we would have to try and understand is that we would have to do maybe more yen trade against the number of euro contracts that we've got. So maybe for every €1 we buy or sell, we maybe buy or sell 2 Japanese yen contracts. So we start learning about the relationship of these two numbers. We start learning about the relationship, about how far these numbers separate, and how we can start looking at that in terms of the way that spreads develop. This is why you do these exercises, so that you can start understanding the process. So in other words, if we're going to make a profit on this, the euro needs to move into profit. In other words, we might as well just be in an outright trade, because all we've done is we've just reduced the outright positioning. The chances of us making profits if we're wrong on the euro but right on the Japanese yen are very, very slim because of volatility, of course. So this is one of the things that we start to recognize as a norm, isn't it? This idea is we've got to try and understand this as a process. We've got to try and understand the relative value of these two elements, these two instruments. And as I said, what we're basically trading is euro-yen, aren't we? We're trading euro-yen. Now, I'm not saying you would trade these as spread traders, but what I am saying is what you would be looking at is trying to figure out what you would be trying to do. Now, the dollar-yen is going up, so generally, as a rule, you would be short euros. So you'd have been short euros, and you'd be making $700 in that short position. You wouldn't be offsetting it against the yen position. But dollar-yen is currently in a little bit of an uptick. It's a green candle. So in a green candle, I'm generally going to be selling euros, just as an outright. We're not talking about an outright here. We're talking about a spread. So this is something you start watching, you start understanding the process between these two markets. And obviously, you've just set up a spread. It might take an hour to develop. It might take 5 minutes to develop. But that's what you do when you're spread trading. We'll come back to it in due course. It doesn't look like there's going to be very much happening with it for a little bit of time. And we'll come back when it's in profit, of course. We'll come back when it's back in profit. And I think that'll probably be in about 10, 15 minutes. In terms of the market, excuse me, in terms of the market story, you can see that there was a couple of situations starting to develop with the dollar itself, actually, long dollars. See that? There was actually a situation here where we've got a long dollar trade starting to set up. So if you're going to do anything on the euro, of course, it would be a sell. Well, that's exactly what we just discussed. But we are in a buy trade on the euro because we got short the yen instead. And that's obviously where the problem's been for that euro position. So this dollar would have given you a good, clear idea about the fact that you'd have been buying dollars and selling euros instead of buying euros. And that would have given you a nice profit on that dollar position right there. So it's all about process. Now, obviously, if we were trying to trade this, which we'll do this after the cash open. We'll probably do this from about 3:30 onwards for about a half hour or so. If you were trying to do this, this would be a spread trade. You'd be selling at the moment the orange line. You'd be buying maybe the black line or the red line, and obviously you could sell the orange line and buy the black line and the red line. You're obviously going to be doing a trade therefore on the gold, the dollar, and on oil. You'd be buying oil against the position on gold, and you'd be buying oil against the position on the dollar. And that would be a spread trade. That would be two spreads you'd be in terms of that current storyline. And that's okay, because that's what you'd be trading right now. You'd be able to develop out that spread. So obviously I'm in that other pesky spread at the moment. So at the moment I'm just waiting for that spread to go into profit, which it nearly is in profit. It'll be there very shortly. And obviously when that spread goes into profit, if this is still setting up, we'll take this little spread into our books. We've got the cash open in about 23 minutes. I'll go and do the cats just now, see if there's any interesting setups, and then we'll get the cash open out the way. Coming into the cash open, one of the things you want to try and check is the curve. What is the bond traders doing? Ask the question. Ask the question. Because if you're in the bond pit and you notice that the guys in the yen pit are screaming, if you notice that the guys in the equity pit are screaming, you know something's happening, and you've got an opportunity to maybe take advantage of those guys going nuts in one of the other pits, right? You can see something's happening, and you start dealing in your bond. You start actually doing business. You start playing the game. This is what we've got to do as traders. We're not here to spectate. We're here to speculate. We're here to take on risk. We're here to actually take on risk. That's our job. That's what we get paid for. If we get paid for taking on risk, well, guess what, guys? You've got to take it on. That's what you get money for. That's what you're getting the money for. If you don't take on risk, guys, you don't get paid, right? So that's what you get paid for when you're a trader, to take on the risk of the commercials. It's that spread trading profit, by the way. We're up $350 on the euro, $475. As I said, it was only going to be a matter of time before it did go into profit, because it was obviously quite a wide spread developing here. So you can see that it's now moved into a very strong position here. So what you do is you start managing out your position. You start offering and bidding, and you start offering and bidding, and you just keep your offers and bids coming in whilst your spread is still making you money. And obviously your job is to try and get out of that deal as efficiently as possible. Now you're obviously starting to pick up a bit of business here. It's starting to run away from you on the Japanese yen here. But that's okay, because obviously you're still making that profit on that other trade. But you've also got to remember, you can cancel out those other trades as soon as possible. But obviously if it's starting to move, your job here is to close off your yen position and then just close off the outstanding entries there. And now you're obviously trying just to manage out this position here. You're able to take out these trades here for a nice profit. And that was a brilliant spread trade, wasn't it, when you think about it? A brilliant spread trade. So you can see that this is how this whole trade works. And there we go. A huge spread profit. $656 we made on that trade net. $656 net. And that's just because the gold price started to move away from us during the trade. Pretty good. Well, $656, guys. We were only in 10 spreads. That's an average of $60 per spread. $60. We were only in the trade for what? 4 minutes, 5 minutes? So I know it's not a lot of money, guys, but we're spreading it, remember. We're not trading as outrights. The average spread is between $50 and $100, remember. That's what our average target price for a spread profit is, as you know, because we've talked about it before. Okay, because that spread's now flat, we could maybe start thinking about this this oil dollar position, right? Yes? That oil dollar position looks really quite interesting. So you'll maybe buying some dollars. Maybe buying some dollars, and we'll maybe try and put a bit of business done on the oil. Spread is on, guys. If anybody did it. Yep, we've sold this. We've sold 3 6Es and we've bought 3 oil. Sam sold 3 6Es and we bought 3 oil. That's what we've done on the actual spread itself there. So there's the trade. We bought 3 oil and we sold 3 6E contracts. So you can see that we quickly went into $100 profit on the three spreads, but we're really targeting $150 to $300 on this, right? $150 to $300. We want to make $50 at least per spread every time we take a spread. And that gives us an idea about realistic target prices. I'm up about $150 just now. So there's $110. So what I'm going to try and do is I'm going to try and take the oil out at profit whilst the euro's in this position. And we'll try and just keep improving our overall P&L. We've taken profits on that. I've closed off that trade for the time being, and we'll maybe go back in again and do another bit of business. We'll maybe do another bit of business, guys.